This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 353 was produced on December 8th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Forest for the Trees founder Luke Gormen returns as this week's feature interview guest. Luke and I will discuss whether the bear market rally in equities is over, whether inflation has peaked, and how the U.S. government will fund deficit spending in an era where China and Russia are no longer ready buyers of U.S. debt issuance.
And I'm Patrick Serezna. Listeners, be sure to stay tuned for our Postgame segment after Eric's feature interview with Luke Gormen, when Eric, Nick, and I will discuss the charts on the S&P 500, NASDAQ, gold, and the oil markets. We'll also continue our conversation on option strategies to consider for hedging your portfolio. Now, Eric, before we go on to our feature interview with Luke, let's cover crude oil, starting with those EIA inventory data.
EIA posted a crude oil drawdown of 5.2 million barrels, and that was really 7.3 million barrels after you add in the 2.1 million barrels that was drawn down out of the Strategic Petroleum Reserve. Cushing, Oklahoma, drawing down another desperately needed 373,000 barrels. The big builds were in finished products, with gasoline building 5.3 million barrels and distillates building a whopping 6.2 million barrels. U.S. production ticked up 100,000 barrels to 12.2 million barrels. The tape action. The market tanked after inventory data, probably for fear that those gigantic product builds indicate a collapse in demand. But Tracy Schuchart posted a Twitter thread explaining that large product builds are typical this time of year for tax reasons, and citing extremely high refinery utilization as evidence that this week's large finished product builds were more likely the result of extra production due to coming out of refinery maintenance season as opposed to a collapse in demand. One way or another, though, the market wasn't reading Tracy's thread, and it took a nosedive and probably has farther to go to the downside. As I reported a couple of weeks ago, the front of the WTI curve has moved decisively into contango, with the first 5 months of the curve now firmly in contango, and the rest of the curve that's still in backwardation crashing fast toward contango. So I'll take this opportunity to explain why state transitions in crude oil term structure from structural contango to backwardation, or from backwardation to contango, as is happening now, tend to be self-reinforcing and predictive of further moves in the flat price. Recall when we had Ola Hansen on the program several months ago, Ola explained that in a situation where you have backwardation in futures markets, it means that position traders that hold their positions and roll them forward every month are getting paid a nice juicy roll premium, even if the flat price stays exactly the same. So when there's no change in price, you're making a substantial amount of carry premium every single month because you make a profit when you roll that long futures contract forward in a backwardated market, because each time you roll it forward, you're closing the old contract at one price and then buying the next month's contract at a lower price. As Ola explained, that attracts a lot of position traders to the market. That begets more buying. That carries the front month price even higher. The even higher front month price results in even more backwardation. That attracts even more buyers to the market because they want to get in on that fantastic deal of being able to hold a position that pays them a positive carry even if the flat price doesn't change at all. And of course, the flat price was trending up at the time. What we have now is the exact opposite. We're moving from a backwardated market into a contango market. That means all of a sudden that those long position traders that are holding a position in crude oil, hoping it's going to turn around, are now paying a roll penalty. Every single month, they're paying a tax, effectively, to roll that position, selling the front month contract and then having to buy back the next month at a higher price, even though the underlying price didn't change. As a result, that means they get out of the market. That causes the front month price to go down even more. And as it goes down even more, the contango gets steeper. And that means that even more traders want to get out of the trade. So we have this self-reinforcing vicious cycle going on right now, where the more that the market goes down, the more that it steepens the contango, the more that it adds yet another incentive for position traders to abandon their long positions. So with regard to the short-term trend, moving average signals, and term structure, the market looks incredibly bearish, with more downside price action seeming quite likely, at least based on those factors. But wait, it's essential to understand that this is all happening because of perceptions about collapsing demand. The supply story is anything but bearish. Global crude oil inventory, both commercial and strategic petroleum reserves, is at generational lows and is still being drawn down. Another 7 million barrels in the United States this week, including the SPR draw. Total oil being consumed exceeds total oil supplied from oil fields. Inventory is going down, not up, and it's at generational lows. The market is clearly anticipating a collapse in demand due to the coming global recession, and that's probably the right view. But this absolutely does not negate my view that due to insufficient supply, it is literally impossible for the global economy to return to pre-pandemic growth trajectory. Why that's so significant? It means that once the coming global recession takes hold, we cannot recover from it completely due to insufficient energy supply. A global energy crisis could hold the global economy in an extended recession or even worsen it into a depression. From a trading standpoint, I'm happy to be on the sidelines, trying to call a bottom in this market where downside price action is being supported now by a state transition from backwardation to contango is suicidal. That's catching a falling knife. But there's no way that I would short this market. A combination of China reopening and Russia weaponizing oil prices and withholding supply could easily shock the market back over $100 as an outlier scenario, but it could happen in a day or two. The rational trading strategy is to wait this out and to hope for much lower prices to buy at the depths of the coming recession. That's a long way off, as David Rosenberg cautioned us last week, but when we get to that point, I think it's going to be a buying opportunity of a lifetime.
Well, this week's featured interview guest is Forest for the Trees founder, Luke Gormen. Eric, why did we get Luke back on the show this week?
Well, Patrick, Luke is one of our listener favorites, and we're overdue. It's been at least 6 months since we had him on. I'm really eager to get his take on how the U.S. government is going to finance its deficit spending in this new world order we're in, where there's a conflict between superpowers, and I don't think Russia and China are any longer going to be ready buyers of U.S. Treasury paper.
Well, Eric's interview with Luke is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Forest for the Trees founder Luke Gormen. Luke, it's great to get you back on MacroVoices. It's been way too long. Obviously, the talk of the town is it a bear market rally or is it actually the bottom is in? We got above the 200-day moving average, stayed there for a couple of days, but on Monday we saw a big correction to the downside. Is it all over or is this just a pause?
It's great to be back on. Thanks for me back on, Eric. I think it's probably a bear market rally still. I think it probably still is a bear market rally, but I don't have high conviction in that.
And what is the source of that hesitation when you say you don't have high conviction? It sounds like you think maybe it's not a bear market rally. Is that contingent on Fed policy, or what makes you question that?
Yeah, it really is contingent on Fed policy and Treasury policy, right? So if you look at couple big things that have grabbed our attention in recent weeks. So back on October 31st, Treasury came out and U.S. Treasury came out and doubled essentially their estimate for the deficit that the United States is going to run in the fourth quarter of 2022 and the first quarter of 2023. And it was pretty noteworthy in that fourth quarter alone, they took the net borrowing estimate from $400 billion up to $550 billion in just a 3-month span. So back on August 1st, they thought they would need to borrow $400 billion in 4Q22, and they're actually going to borrow $550 billion in 4Q22, keeping TGA consistent. So borrowing needs rose 37% in 3 months. And so all else equal, if you hold everything else equal and you effectively double the deficit nearly, so you're taking the U.S. deficit from $1.3 trillion to a $2.6 trillion, an annualized rate over the next 6 months. If you don't do more QE, if you don't otherwise inject dollar liquidity into the system, that's going to be positive for the dollar, and I think it's going to be negative for everything else. And I think we're going to see sort of a continuation of the market regime we've had really since, call it January, February of this year, which is dollar up, everything else down, and maybe oil up too. This deficit, and the issue is ultimately sort of the second big thing we noted there, which is, I had a chart recently for clients where we showed that anytime the U.S. deficit was more than, I believe it was 20% of the projected global GDP growth in nominal terms over the last 25 years, the Fed, every single time that U.S. deficit was more than 20% of global GDP growth in nominal dollar terms, the Fed did QE, basically to help finance it. The one exception to that rule was 2022, where I believe it was a 32% of global GDP growth based on IMF GDP growth estimates for the world. And you saw what we got, which was dollar up, everything else down, and oil up, and really oil flat. And the point here is that with what Treasury just announced on October 31st, right now, assuming that global GDP growth is not taken down further from what the IMF is looking for 2023, the U.S. deficit as a percent of global GDP growth is going to be like 68%. So the point is that this deficit increase, there's no balance sheet. There's not enough balance sheet globally to finance this without either selling other assets, like we've seen this year, without driving the dollar up, it's going to continue this dollar squeeze, and without probably driving down the price of treasuries, yields up, which is exactly the regime we've seen. So if that's the regime we're going to get, that's why I say I think it's a bear market rally, is the amount by which the U.S. deficit, or the relative size of the U.S. deficit relative to global GDP growth, is one of the highest in 25 years. And if there is not excess dollar liquidity supplied by the Fed from somewhere, I think we're on pace for another pretty ugly year to start the year. Now, when I hesitate, what am I looking for? Well, we were seeing this play out through September. We saw things start to break. You saw increasing stress in the Treasury market. You saw rising rates in a recession, or in a global slowdown. Recession is too strong a term. But you saw the Treasury market not performing, actually performing worse than equities in a global sell-off, which was unprecedented, going back 60 years. Great chart that Michael Guyed had a couple weeks ago. Then all of a sudden in October, we've seen really what's quietly been a massive injection of dollar liquidity. You saw the reverse repo balances come down. I believe that number's 400 billion, 204. I think it's maybe 240 billion. You've seen the TGA, the Treasury General Account, come down quite a bit as well. And then more recently, the Fed running operating losses ends up leading to a short-term injection of liquidity as well by virtue of the Fed effectively paying banks. They are paying banks by virtue of running operating losses. So you've had sort of this dollar injection of liquidity that you've seen it in the markets. It's sort of been the opposite of what we had year to date. Dollar down, yields down in treasuries, yields down across the bond market, risk assets up, gold up, Bitcoin has stabilized. But the amount of the deficit is so big, and now tax receipts are starting to roll over for the U.S., which is likely going to get worse in the first half of next year. So you're just faced with this really big gap between what the deficit is projected to be in the U.S. and what the world's ability to finance that deficit is, which is global GDP growth in dollar terms. And though there will be a big crowding out impact, even bigger than what we saw in 2022, unless you get much more dollar liquidity injected or continue to be injected.
Let's talk about inflation next. I've been kind of surprised. For quite a while on MacroVoices, most of my guests were telling me they thought we were at the beginning of a significant secular monetary inflation. Lately, a lot of really smart people are telling me, no, look, what's really been going on here has all been pandemic effects. Oil demand recovered faster than oil supply was able to recover to match it because of the pandemic shock. The supply chains caused a lot of increased consumer prices, but it's not, according to Jeff Snyder, for example, it's not monetary inflation that's driving the price inflation. That has not been my view, but I'm starting to question myself with a lot of smart people saying that. What do you make of both that view and just the topic of inflation generally?
I think there's a tactical view, and I think there's the secular view, or more. And I think tactically, I would tend to agree with Jeff that we probably, whenever we saw that 8.4 or 8.3% print in CPI, whenever that was, I guess 2-3 months ago, maybe 4 months ago now, that was probably the local high. You've seen a number of different data series that have rolled over, used cars, home prices, lumber, certain industrial commodities, etc. And so I think from a tactical perspective, I think that's right. I do think there was monetary inflation at the same time. I think that is being or has been reversed up until the October, November sort of injection of liquidity that was just referenced. You'd seen that monetary inflation reversed on some level. And that drove, I think, a peaking in that from a local perspective. Now, secularly, to me, it continues to be underappreciated that inflation was the only way the U.S. government was squaring the circle from a fiscal perspective. The U.S., as the reserve currency issuer of the world, it's why we focus on it, they have a balance of payments problem. And when the reserve currency of the world has a balance of payments problem, everybody has a balance of payments problem. And that's what I was just referring to before about this. There's not enough private balance sheet globally to fund U.S. deficits next year at anywhere near current rates or current dollar price, dollar level. And so when we talk about tactical versus secular inflation, tactically, yeah, I think it's probably rolling over for a bit. Secularly, when you look at the U.S.'s fiscal position, where entitlements, we're going to spend probably $2.9 or $3 trillion cash out the door in entitlements next year. We're going to spend probably $900 billion on defense cash out the door next year. So we'll call that 3.9 trillion. And then you're going to spend probably pro forma, certainly on a run rate basis, probably close to $1.3 trillion in Treasury spending all in. So you're going to be, what's that, 4.1, 4.2 to 4.5, just in the big three expenditures, what we call the big three expenditures: entitlement, pay-goes, Treasury spending, and defense. And so When we compare that to tax receipts in the United States in fiscal 22 were an all-time record. I believe it was 4.6 trillion, something like that. Well, everyone has been very, very quick to point out how silly the everything bubble was. Crypto, housing, stocks, everything bubble. Great. Not as many people are pointing out that the everything bubble drove a tax receipt bubble. Tax receipts were up like 40% in in fiscal 21, 2020, 2022. You can see it on a chart. It's an absolute spike. April 2022, which is usually your biggest tax receipt month of the year for obvious reasons, right? April 15th, tax filing day for individuals. The United States collected $863 billion in income taxes, or in total tax receipts in April 2022. Well, what was that from? Well, that was from the everything bubble in 2021. It was that amount was up, I believe, $430 billion year over year versus April 2021. And it was up $380 billion versus pre-COVID April 2019. So you've got everyone is having the inflation debate, and I think it's an important debate to have, but I think they're also missing the forest for the trees on this, which is the U.S. fiscal position is in deep trouble without that inflation. And so to the extent that inflation comes down, tax receipts are going to come down. That's already happening. And you're going to end up in this position where we were in 2019 all over again, really in 2020, I suppose it was, where your big three expenditures are going to go back to being 110, 120% of your tax receipts. And that is just sort of comes to the same conclusion as before from a different angle, which is that deficit needs to get financed, and either the Fed prints it, in which case we get dollar down, risk up, like we had in the sort of the April 20 through, I would call it, January 21 monetary regime, or the Fed stands aside and says we're not financing these deficits, in which case we go back to the point I made about the insufficient global balance sheet to finance this, and we're going to find out in markets what the clearing rate for treasuries is on that. And that yield, so what we'll have is a slowdown we'll have a much stronger dollar, which will drive a global slowdown in corporate profits. And you're going to see that treasury markets probably continue to sell off even with that global slowdown. And that's going to sort of drive a wash, rinse, repeat deflationary cycle until the Fed steps in. So I think there's a story really of two, a tactical, it's slowing down. Secularly, I think we're in the early stages of a massive secular inflationary regime from a number of reasons. Number one, the Fed is ultimately going to have to finance this one way or another, whether they call it QE or they call it swap lines or they call it reduction of the RRP. However they do it, they're going to have to inject the liquidity at some point next year, in my view. Number two, you get into things like deglobalization. If globalization was inflationary or disinflationary or deflationary, reshoring and deglobalization is going to be inflationary secularly. Peak cheap energy, we're seeing this all over. It's getting harder and harder for shale to grow production. U.S. shale has been the marginal oil producer for the last 15 years. China has been offline, and U.S. shale's peaking. China comes back online in a bigger way. I think peak cheap energy is a very important secular inflationary driver. You've had workforce reductions. Yes, some of it's temporary bottleneck stuff. Some of it, the Fed did a paper on long COVID a couple months ago. You've got millions of people out of the workforce that may not be coming back anytime soon. That's inflationary. So there's a number of different things that I think are very secularly inflationary from a supply chain perspective that aren't going to change. They're going to get worse in terms of driving inflation. And then I think on top of that, you've got this U.S. balance of payments, which in the short run, the Fed can play tough guy, but they can only play tough guy until it comes time to call the U.S. Marines and say, sorry, we've got to stop sending you. You guys can't spend. You guys have to come home because we don't have the money. And when that happens, they're going to print the money.
Okay, Luke, let me play that back both to make sure I got it straight, but also because I want to talk about what happens next. So, we had in 2020 a global pandemic that results in an obscene amount of liquidity being injected by central banks into the economy. That leads in 2021 to an everything bubble, including tax receipts. In 2022, governments, including the U.S. government, are spending beyond their means, and we're running up deficits. Of course, the attitude of policymakers is deficits don't matter. There's always a market for U.S. Treasury paper. We'll just print up some treasuries and sell them off, and the world will finance our deficits. And what you're saying is, wait a minute, the picture is not what it used to be. Look at what's going on in Europe right now. It's not exactly like there's a huge appetite for buying up U.S. Treasuries, other than the Fed itself could buy it. But as you know, and I know, the Fed's ability to buy treasuries, as it did with QE for years and years, was enabled by a deflationary backdrop where they could get away with doing with that because there was no inflation that they had to risk exacerbating. Now there is inflation to risk exacerbating. So first, did I get the chronology approximately right? And if so, let's just talk about what the choices that we're left with are, because it sounds like we've got governments continuing to deficit spend, or at least the U.S. government is spending away. There's no sign of restraint in sight. And you're questioning where the heck the money's going to come from. And it certainly sounds to me like if the Fed is called upon to step in and bail things out, bail out the Treasury market, that's going to blow up a bunch of other things, isn't it?
Absolutely. No, you got the chronology much more than approximately right. And to me, that's the elephant in the room that nobody wants to talk about. When you say, well, everyone just assumes, the politicians always assume there's plenty of demand for treasuries. Well, of course, there's plenty of demand for treasuries. The question, it's really a function of two things. Number one, we've never seen the deficits this big relative to global growth, number one. And number two, with U.S. debt and deficits this high, it's not a question of will there be demand for treasuries at a certain price. Of course there will be. The question is, can the U.S. government afford that price without going into a debt spiral? I mean, look, 10%, 12%, sure, they can afford the treasuries, or sure, they can place that paper. But the problem is to your point, that's a world where everything else is imploding. You're into a debt spiral again, because we have never gone into a slowdown with U.S. debt to GDP at 120% of GDP. We've never gone into a slowdown with U.S. deficits at 7 to 8, 9% of GDP. I mean, it's unprecedented since at least the end of World War II, and there's things that are very different now versus then. So I think you've got it exactly right, which is we're running headlong into a situation where the Fed's going to be forced to make a choice, and that's going to be an interesting moment.
It seems to me there's more to it than just the governmental death spiral of debt that you talked about, because pension funds around the world have already taken a hit that they didn't think was possible. You know, the whole idea of risk parity was you're supposed to do the portfolio construction so that when you're losing big on equities, you're making it back in bonds. And it didn't work out that way. We're losing on both. Now that you're losing on both, a lot of people are kind of feeling like, okay, we can't go any lower than this because that would really break the system. Luke, I think we're going lower than this on both stocks and bonds. How does the system break? And, is it a government death spiral that we need to worry about first? Or do other things like a wholesale failure of pension systems around the world lead the way before we even worry about something like that?
Well, I would say you've already probably started to see it in the more sensitive things, right? So you saw it in the British LDI, the leveraged gilt pension scheme, right? That needed to be bailed out. Let's call it what it is. Right at the end of September. You've seen obviously FTX and crypto. This blow up has happened. And Wall Street, I think, generally is like, there was a leveraged scheme, shouldn't happen. It was unique to British. It was unique to the British financial system. It's not systemic. Okay. Crypto's crypto, haha. They can't afford Lamborghinis anymore. And it's not systemic. Okay. Now, though, you're starting to see some interesting things in the last couple of weeks, right? I mean, heard some credible rumblings recently that commercial real estate is starting to freeze up. Those markets are starting to freeze up, right? Bid-ask is blowing out. Then last week you had the Blackstone, right? We're freezing redemptions. We're gating redemptions. Today, you had Starwood follow up. We're freezing redemptions. And this is how this kind of a thing starts, right? Because if they gate redemptions, that's fine. It is what it is, right? We don't want to mark the market. We're funding short, we're lending long, and our longs are illiquid. And what they're really saying is we're just going to sort of, we're going to extend and pretend until the Fed comes and saves us, or we're going to try to hold out for a bit longer. That's what they're really doing, which again is fine. It's exactly what I would do. But of course, in free markets, what happens then is liquidity. People that need liquidity are going to go somewhere else to source that liquidity. You don't necessarily sell what you want to, you sell what you can. And so I think to answer your question directly, I think you're starting to see some of these symptoms go sort of from the periphery to more core systemically important markets. I mean, there was even a great article last week in the FT. The court documents just came out for the nickel trade, that nickel trade chaos back in March during the sanctions. And it turns out that the LME basically pulled a Hunt brothers on Elliott and Jane Street, which is, hey, we were going to go broke. 6 or 7 market makers, clearing firms might have gone into default. This had the chance to be systemic. And so, yes, you were supposed to be up a couple $100 million, Elliott, but sorry, we're breaking your trades. And Elliott is suing them, and understandably so. And I don't have any legal thoughts or perspectives on that. But my point is that I think you're already starting to see these sort of the rule changes put in place when things start to get these systemic pressures start to build, which is, hey, we're going to gate redemptions. Hey, we're going to break trades. And I don't think these are going to be the last things we see, if for no other reason than, look at the Fed's operating loss, right? Look at the Fed. Now, does it matter for the Fed? No, the Fed can't go bankrupt. But the Fed is down like $1.2 trillion on its bond portfolio, and it's running these massive operating losses. There's a great chart you can see. It's remittances to the Treasury, and it's a most incredible chart. It's sort of like Nicholas Nassim Taleb's the 1,000 days in the life of a turkey, right? Which is, for like 1,000 days, the Fed just predictably, prints money and clips a coupon and mails it to Treasury. And then all of a sudden, one day, it falls off the table. And like the Fed's book there's a lot of books out there that look exactly like the Fed, right? Borrow short, lend long, and now they're upside down. And so I think we're starting to see the symptoms of this borrow short, lend long, where the first thing is gate, extend and pretend, hold on, hope the Fed comes in with more liquidity. The Fed has given a little more liquidity, to our earlier point, over the last couple of months. But unless it's sort of explicit and big, I think it just bought time.
Luke, it seems to me there's another dimension to this that I think is very relevant, but most people don't seem to have picked up on yet, even though it's obvious, which is I think that the bifurcation that's being created by this war cycle is here to stay. In other words, I don't think this is just about Ukraine. I think that the United States, China, and Russia are pitted against one another in a long-term, ongoing change of the global power regime. If that's true, let's go back to what you said a few minutes ago about how there's this complacency in Washington. We'll just deficit spend. It doesn't matter because there's plenty of buyers for U.S. Treasuries. Well, hang on a second. Historically, the biggest buyers of U.S. Treasuries have been China and Russia. I kind of got a feeling they're not buying anymore. So do people realize that the game has changed? And I guess, first of all, would you agree with me that this bifurcation and deglobalization of the global economy is going to be a thing? And if so, what are the other knock-on effects and consequences of it?
I absolutely agree it's a thing. And I it's interesting, a couple of weeks after we talked last back in early June, Eric, Vladimir Putin gave a speech. And it was arguably one of the most important speeches in years. And of course, there was absolute crickets on the speech from the Western media because they never say anything. But there was one point in his speech in particular that I thought was really, really important, which is said is, look, you want us to, these FX reserves in dollars and euros depreciate at 8% per year. He flat out said that. And it was really interesting because 8% per year is the compound annual growth rate of U.S. Treasury issuance since 2008. 8% a year, 8% more treasuries, 8%. Now, if I'm an oil seller, if I'm the world's gas station, as John McCain called them, or a gas station masquerading as a country, or however he phrased it, if I'm Russia and I'm big in oil and gas and commodities, all of which deplete, every oil field has at some point depleted. I know I have a finite resource base. And so if I'm going to sell my energy, and oh, by the way, knowing that the world's biggest marginal producer of energy, shale, is peaking. So sort of like the cap on oil prices has been shale to some big extent over the last 10 to 12 years. And that cap is now getting removed because we can't produce much more, not at these prices. So if I'm Putin, the Americans want me to sell my oil and then store it in debt whose supply is going to grow 8% per year, CAGR, whose yield has never really able to get above 3% without something blowing up and the Americans having to print money to prevent the whole thing from coming unhinged. And it's likely that oil's probably going to rise secularly with U.S. shale production rising. So in oil terms, the value of U.S. Treasury bonds is probably, the supply of Treasury is going to rise 8. Say that, oil rises 5 to 8% per year if shale peaks, just sort of smoothed. And it's a terrible deal for him. So what has he done? He stopped buying treasuries back in 2008 or 2010, and he bought gold instead, a lot of gold. Because you look over time, gold and oil tend to move over time. They separate, but all in all, for long spans of time, gold holds its value versus oil. Treasuries at sub 3% can't. And the U.S. can't raise rates enough to compensate you for that. So there was this really important speech that he gave. He flat out talked about the real issue and I think that Ukraine is really just a symptom of, which is the Russians and the Chinese and the world's creditors more broadly cannot afford to store their surpluses in Western financial instruments broadly, but U.S. Treasuries specifically, at negative real interest rates, because they will end up with a pile of paper that is fallen drastically against energy, and then they will go run into financial crises. They won't be able to afford oil. Their economies will collapse, and they'll have political problems. And that's a matter of national security that is a red line for places like China and Russia. On the flip side, going back to the point we were just talking about with the U.S.'s debt level and the U.S.'s deficit levels, we cannot afford to float this without negative real interest rates for a sustained period of time. And so it's a matter of U.S. national security that we get somebody to buy these at negative real interest rates. And we can have the Fed do it, but that then impacts the dollar, as we've repeatedly seen. When the Fed finances deficits, the dollar goes down, and that's fine when the dollar's high. But there's the limit to how much we can do that. It's inflationary over time. We've seen that. We now see that with the inflation of the last couple of years. So I think we are absolutely at a huge moment of deglobalization, and I think it is very much an impasse that extends far beyond Ukraine, which is there is this fundamental disagreement, which is the U.S. needs China and Russia and Saudi and everybody else to finance U.S. deficits at negative real interest rates. And it's a matter of national security. And China, Russia, Saudi, and everybody else, it's a matter of national security that they don't finance U.S. deficits at real interest rates because they end up importing the inflation. So I absolutely think we're seeing a fracturing. I absolutely think it's inflationary. I absolutely do not think it's likely to be resolved anytime soon, even if we had a peace in Ukraine tomorrow. Because the real, I think, underlying fundamental issue is the debt. Is who's gonna buy the debt, and we want the foreigners to buy it at a negative real rate, and the foreigners are saying no, you buy it, Americans, if you like it so much.
Let's talk about what investors should do in reaction to all of those views, Luke, because back in the day, the pretty common view was if what you're worried about is governments are going to debase the currency and they're going to deficit spend beyond their means and they're going to get into a debt trap, what you want to do is you want to buy gold in order to protect yourself and hedge against that exposure to the government's fiat money system. I would say, though, that what we saw up until the 1st of November was pretty darn clear evidence that even as inflation is really taking off, even as we're seeing all of the gold bugs, greatest fears realized, which is the currency has been debased, inflation is starting to run away, what gold actually responded to was the Fed being forced to raise short-term rates. Basically, was bearish for gold, even though the reason they were forced to do that was actually the realization of what all the gold bugs have been worried about for so many years. Now, something changed dramatically at the beginning of November. I'm assuming that it must have been the perception that inflation has peaked with that, we had an inflation print which was finally substantially lower than the previous one. And, inflation is a famously noisy series, so I'm not necessarily persuaded that was the final and last peak. Is it time now that the gold market has just figured out reality, or is this a false breakout in gold because we're really going back to whatever that regime was that lasted until November as soon as the Fed is forced to raise rates again? How should we think about where gold is going from here?
Well, it's interesting because I agree. You've seen all of the things you'd expect, you'd want to see as a gold bug, and you also didn't see price move the way you would think. Now, with that said,
and it was actually inflation coming down, which resulted in the
exactly right. So it tells you there's still that huge impact on the financialized gold market, right? The real still trading is still very influenced on real rates. Now, a couple things. Number one, central bank buying of gold in the third quarter, even as we're in this absolute dollar spike, this dollar shortage, foreign central banks somehow found the money to buy the most gold in a quarter that they'd ever bought, ever. I think it was 400 tons in a quarter. Incredible. You can see it in a chart. It's a spike, which I think is interesting. I think it's interesting that gold prices fell when central banks did that. Curious. Particularly when you saw physical buying of gold elsewhere around the world. The source was, a lot of the sources came from ETFs. So basically, ETFs were unloading gold to retail and to central banks, and at lower prices. So I thought that was number one interesting, which suggests to me that the fundamentals led to gold buying. It just didn't show up in the price at that point, as it was overwhelmed by what real rates did. Now, I'd also say, given what real rates did, the fact that gold only got down to whatever it did, 1630 or 1650 or something at the lows, I think is really, really encouraging for gold. I mean, gold should have gone with the fastest rate hikes by the Fed in 40 years, and all they could do is knock gold down to 1630 or 1650. Like, wow. What happens when something breaks? Because really, if the Fed really wants to beat deflation, if they really want to, they're going to have to stand aside and let some really big, important things go bankrupt. And, does Powell really want to go to the Christmas party or the 4th of July party 2023 and go see his buddies after he just let one of them go bankrupt? I don't think so. I don't think he's going to do that. I don't think he can do that. So to me, it was interesting that gold, not just on that inflation print, but that also coincides with that point I made earlier, where that was October 31st that the U.S. government came out and said, or the U.S. Treasury came out and said, oops, the deficit for the next 6 months is not going to be a $1.3 trillion run rate like it was the last 6 months. It's a $2.6 trillion run rate. And that, to me, I think it might have had something to do with waking gold up as well, which is, there's been this credibility that the Fed is going to do whatever it takes and they're going to get inflation down. Like, I think gold really is going to do well once it dawns on everybody that not only is inflation going back below 6% for the next 5 years, like it might be 8 to 10% this time next year. Because the only way the Fed's going to avoid that outcome is if they're willing to let some very systemically important people go bankrupt. And I don't think they're willing to.
Let's talk about the Fed's policy going forward. Let's suppose that it's not 8% next year, but it's 4.5% next year. At that point, maybe I'm crazy, but I would like to think, okay, the Fed should still be learning a lesson. Their target was 2%. It's more than double that. Obviously, their previous policies of bailing out financial markets left and right have led to inflation that they didn't anticipate. They ought to learn a lesson, and they ought to get their act together and not do that anymore. I suppose the counter view would be, hey, from 8%, we came all the way down to 4.5%. It's getting better. It's okay to print money like it's going out of style again. How do you think the Fed is going to behave in terms of, when we were sub 2%, it seemed like every time the market crashed, the Fed was there. The so-called Fed put was very much in force to bail out the financial markets anytime there was a significant problem. If we got back down to a steady 4.5% to 5% inflation, but not 2%, do you think the Fed would change its ways and realize, we're still at double what we originally intended? Or do you think they would just adjust their target level to 4% to match actual and declare success and not worry about it too much?
I don't think they're going to change their target just because I think they would see that as defeat. I think they would jawbone and say we've made a lot of progress, and they'd probably ask for help from the BLS or whoever it is that calculates inflation to try to get the number lower and sort of jawbone it. But I think they are ultimately beholden to the fiscal situation. They can play tough guy, but the market's going to set the price of borrowing for the U.S. government. And that's, I think, going to be a real sensitive issue given that dynamic we talked about before, which is right now projected deficits are running at 68% of projected global GDP growth next year. And that's assuming like 2.5% global GDP growth, right? Like if you as the dollar goes up and rates go up, as things slow, that growth will slow. And, then this won't happen linearly. You'd get a nonlinear rise in the dollar, nonlinear rise in treasury yields, global yields, nonlinear decline in sort of everything else until something systemic snaps. So I don't know how they would spin that. I don't think they're going to raise the target. I think they would try to jawbone it, but I think ultimately I don't think they're going to have a choice. Like whether it's 4.5 or 5 or 6 or 3.5, when the U.S. government's fiscal situation or when something systemic goes, they're going to have to make a really hard decision, which is I'm going to let this system collapse. I'm going to let one systemic thing go, and once one systemic thing goes, as we saw with Lehman, all these notional derivatives start to become net when you take one systemic player and put them into bankruptcy. So they're going to have to decide what, at that point, do they want to be tough guy or do they, and I don't think they can afford to be tough guy. I think they will ultimately step in at that point. And I think they're going to have to loosen into still elevated inflation at some point in 2023.
Luke, I think that's really fascinating because, frankly, I don't think it's a question of them even having the option of playing tough guy. If they try to play tough guy, higher authorities in macroeconomic theory, such as Maxine Waters, are going to step in and say, you're fired. We're the Congress. We're going to spend money whether you like it or not. And if you're not ready to print money in order to buy the Treasury paper, in order to let us spend beyond our means, we'll get somebody who will. So I think that they're forced to. What does that mean when it happens? Because it seems to me like regardless of whether you think we've got a secular inflation now or not, they can create one if we get to a point where there are no natural buyers to support the amount of deficit spending that's going on, and the deficit spending continues, and the Fed is forced either by policy or by having the principal players in the Fed replaced by somebody who's willing to play ball with them, you get to a point where it seems like you do get into that Rudy Haverstein moment where the Fed is just printing money like it's going out of style, and it really is fueling a runaway inflation. Am I right to think that's where this could all be headed? And how long does it take for something like that to play out? Because the biggest mistake I've noticed with people who concern themselves with hyperinflation and such things is they first conceive that it is theoretically possible, and then they convince themselves that it's coming tomorrow morning. This stuff takes a while. So how long would it take to get to the point where the Fed is in such a pickle that they really have to just print money like it's going out of style and fuel a runaway inflation?
I don't think you're there yet. I mean, I think there's always going to be buyers for treasuries. It's just this is the part that everyone keeps leaving out vis-a-vis the Volcker move is, oh, well, the Fed can just be Volcker. Well, U.S. debt to GDP was 30%. U.S. deficits were never more than 3% at the depth of the 80-82 recession. So, like, that's 120% now, and that's 7 to 9% deficits as a percent of GDP. And you've got these off-balance sheet liabilities that are coming on that in a massive way that just wasn't the case. With entitlements, it wasn't the case back in the 70s due to demographics. So there will be demand for the treasuries. The problem is not the question is not will there be demand for the treasuries. The question is will the rate at which there will be sufficient demand for treasuries, given the global balance sheet situation I described earlier, at what rate? And can the U.S. government afford that rate? And I would argue that, and we've done the math, that the 5% Fed funds terminal rate that Fed fund futures or Eurodollar futures have been discounting or right around there, and people are thinking, like, I don't think the U.S. government can afford 5, not on a sustained basis. And that's a problem, because if the U.S. government really can't afford 5 and certainly not 6 on any sustained basis, and we know that because tax receipts are already starting to roll over and deficits are starting to rise again, then how are they going to stop inflation? That's 7, right? The studies have shown, Druckenmiller's on the tape talking about this. Once you get, what did he say? Once inflation's over 5, you've got to raise Fed funds over inflation to get it down. Like, that's the problem. And there was a great study by research affiliates we quoted last week in one of our reports, which know that once inflation gets to 8, it takes on average, I think, 7 to 10 years to get it back to 2. And it takes you raising rates nearly that high. Like, that to me is sort of the elephant in the room that nobody wants to talk about, and that people are pretending they don't need to own gold, and that but once that realization comes, that it's not that there won't be treasury buyers, but that the rate at which there will be treasury buyers, because again, that global balance sheet isn't there with the dollar at 114 where it was, and it's maybe a little bit more there with the dollar at 104, the rate will cause that spiral to happen, right? Where now interest goes up. Okay, they have to finance at higher rates. Okay, that means the deficit goes up, which means and that gets very nonlinear very quick. Now we're not there yet, but that is ultimately the dynamic. Politically, I'm waiting for Congress to wake up and go, wait a minute, you, Mr. Powell, are telling the U.S. people that you want to raise unemployment, which he is, that you are willing to take a recession and possibly a painful recession to the American people, and you're currently going to pay in 2023, you're going to print money and hand it to the banks to the tune of $200 to $300 billion to keep their money in reserves, which is what the Fed is doing. That is a potential, I'm waiting for Elizabeth Warren or Maxine Waters or somebody to go, wait a second, why is he putting the economy in a recession and paying the banks $200 to $300 billion? Now, we all know in the financial markets why he's doing it, but oh my goodness, does it look ugly from a political standpoint? Is it a hot button issue? And I could see that becoming a hot button issue, to your point of, when does the Congress start to squawk about that? And I suspect once their constituency squawks about it, they'll start squawking about it, which they're not squawking that much yet.
Well, Luke, I can't thank you enough for a terrific interview. But before I let you go, please tell our listeners a little bit more about what you do at Forest for the Trees and what they can find at fftt-llc.com.
Absolutely. So we're a macro thematic investment research firm. We aggregate a large amount of data points in an unconventional manner, looking for developing economic bottlenecks to help our clients make money. So we've got different institutional and mass market products. They can find out more information about it at fftt-llc.com.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Luke. Now joining us again in the postgame is Nick Gormen. Now, before we get to the chart deck, Eric, what did you take away with the interview with Luke?
Luke makes incredibly persuasive points about how the U.S. government will finance itself in the New World Order, where Russia and China are no longer friendly towards U.S. treasuries. I think it's going to be really important to watch that and see what happens because, listen, the doomsday bloggers all predicted, someday China and Russia would begin to divest their U.S. treasury holdings and it would crash the dollar overnight and it would all be over and the U.S. bond market would crash. Well, first half of that happened. China and Russia did divest their U.S. Treasury holdings a couple of years ago. They began doing that, and it didn't crash anything. If anything, the opposite happened. The dollar was up, not down. So is this now going to be the point where there's enough pressure in terms of needing to deficit spend and not being able to sell the paper, and maybe Russia and China continuing to move toward gold instead of treasuries as reserves? Is that going to be enough to actually bring about that bear market and runaway yield situation in the U.S., or is it going to turn out that the doomsayers had it wrong anyway? I don't know the answer, but I'm going to be watching carefully to see what happens. I think it's entirely possible that you could see a major bear market in both stocks and bonds in the United States. That would collapse a lot of pension systems. You could have a real domino effect, and maybe it is the big doomsday blog scenario that was predicted years ago. The last few times they predicted something, it didn't come true, so I'm not holding my breath, but I do think it's worth watching this very carefully.
All right, so now let's get to that chart deck. Listeners, you'll find that download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Luke's picture that says, looking for the downloads. So, Nick, let's talk some charts. On page 2, I have that S&P 500. I want to talk about the levels that you're watching because we got a lot of news coming out. Not only do we have the initial inflation kind of number with the PPI coming out tomorrow, but next week we're going to have CPI on Tuesday, followed by the FOMC statement and press conference coming out on Wednesday. And so I'm really curious as to how the options market is pricing volatility in going into next week's headlines.
Yeah, well, looking at next Friday's expiration, which again, as you said, factors in FOMC, CPI, and this Friday's PPI data, we have an expected move on SPX of about 130 points in either direction. So from the current price, upside's around like 40.50 roughly. Downside would be around 3,800. Support right now is, again, pretty heavy at 3,700. 3,900 has been acting as support recently as well. On the upside, resistance would be 41.20 approximately. So I do think we're going to see a lot of volatility, possibly the most volatile week we've seen in many months next week, given the CPI and FOMC data. Eric, what are your thoughts on the S&P right here?
Well, as David Rosenberg said in last week's feature interview, most bear market rallies have failed at or near the 200-day moving average. Now, we did move above the 200 last week, but only for 2 daily closes. Last week, I said if this market was going to roll over and reverse to the downside, it needed to do so pretty darn soon. Well, I guess the market got the message because it sure looks to me like what we have here is a fake break above the 200-day moving average, and the bear market rally has probably topped out. But I also note that despite trading well below the 100-day moving average on Wednesday, a late-day rally brought us back up to close right on the 100-day at around 39.37 on Wednesday. So we haven't seen a decisive close below the 100-day moving average quite yet. So I suppose there's maybe still some room for this to be a bear trap in bull trap's clothing, but I'm still leaning toward the view that the top is probably in, the bear market is probably over, and we're likely to see more downside. My conviction on that bearish view will increase considerably if we see another red daily candle on Thursday and a close well below the 100-day moving average, which right now is right around 39.37 on the S&P.
Yeah, Eric, when you're talking about that 200-day moving average, I put it up on that chart. And, I get that David Rosenberg and your views about the rejection there and his bear market rally. But I think that from a market timing perspective, it's one extra layer for me. I want to start seeing when the price action has definitively started to show distribution. And up until this week, the market has been very systematically doing a relatively bullishly tilted price action, which is all dips getting bought. It continued to make progress. And I think that the real tell for me is going to actually be on how the price action behaves once we get all of these headlines. I actually suspect that, and I wouldn't rule out anyway, the idea that the market can even break to a higher high above 4,100 temporarily, just to kind of wash out eager shorts that may have stops a little too tight. But overall, I feel that this 2-month bear market rally is getting a little bit longer in the tooth. And now that we're going right into the middle of December with all these big headlines, I'm curious whether or not we see this kind of mid-December turn point in the market, and certainly something that I'm watching. Anyway, moving on, Nick, I wanted to, on page 3, we have the NASDAQ. And, my first observation, I want to know the levels, obviously, what the market's anticipating, but when we're looking at these Qs, the price action on those FANG stocks continues to just be brutal. I mean, I know Microsoft has bounced a little bit, but Apple and Amazon and so many of these other names just continue to just have a really rough-looking charts. But what are you seeing here in the options market in terms of the levels?
Yeah, so looking at next week's expiration again for December 16th, which again factors in FOMC and CPI, we're going to see approximately a 12-point move on the Qs. So from the current price, it's around 282 as we speak. We have upside of around 294, 295-ish. And right now, resistance is around 300 on Qs. We have a gap fill again at 310-ish. We also have a gap fill to the downside at 368 approximately. Support area would be around 260 right here. 280 is also heavy support as well. But again, I do think we're going to see a significant move by next Friday, given the data we're going to get in the next week or so. And as you said, the FANGman names, especially Meta, Amazon, Netflix, Google, Apple, they're not looking too hot right now. Meta was pushing toward that gap fill at 130, and then it broke back down again with the negative EU news. So it's possible we see another downside move to that gap fill at 268 area. But again, it's all contingent on the PPI, CPI, and FOMC data that we get in the next week or so.
Yeah, ultimately, it's going to stay correlated to that S&P 500. So it's going to be what direction the whole market takes in the next move. One of the things that I'm curious about is whether the NASDAQ continues to demonstrate a relative underperformance and if the S&P does take a turn down, will the Qs once again be the ones getting hammered the most? I don't know if I would say that there's a very reasonable chance that's the case. I generally want to be underweight the Qs on a relative basis. But what was interesting, though, for me, Nick, was looking at volatility. Like even last week, the VIX, which we have on page 4, temporarily even traded below 20. And it's amazing, we have this bear market rally, so many people skeptical about its sustainability, yet the cost of volatility to hedge up your portfolio is still relatively affordable compared to where volatility's been trading over the course of the year. What's your thinking? Did we put in a short-term bottom in the VIX, and what's your thoughts here?
I do think we did put a short-term bottom in the VIX for sure, because looking at the chart over the last year, we can see heavy support at 20 or so. And each time we've bottomed out, we've risen very rapidly off the bottom and pushed above 30, about 5 times so far in this past year. I don't expect anything different going forward, especially with the data we have coming out in the next week or so. So I do expect to push above 25 perhaps, where we're going to see those 2% daily moves each day in the broad markets. And also looking at the put to call interest right now on the VIX, It's 0.2 right now, meaning that there are 5 calls being opened per put being open right now, which is pretty bearish overall. But again, you mentioned that the hedging costs aren't that expensive in the short term, and I do agree with that. We'll discuss that in a little bit, I guess. Now, moving on to the U.S. dollar on page 5, Eric, has anything changed in your thinking?
Another week, another confirmation of the ongoing downtrend in the Dixie. Last week, I observed that 105.5 was the level to watch, and it clearly broke lower. We tested 104, which was the bottom back in August, just before the big parabolic move up to the top at 115. What we're seeing now is a nice bounce here off of that 104 support level, but how long will it last? It already seems clear that the trend has reversed to the downside, at least in the short to intermediate term. A daily close below 104 will provide further confirmation of that.
Well, Eric, I do get the point. It is still in a distribution cycle, but increasingly, my view here is that even if the Dixie does have a dip down to 103, and on the short term we have some volatility on all these headlines, I think the next 5 to 10 point move on the Dixie is actually to the upside, not to the downside. And so one of the things that, while I agree that the prevailing downtrend is dominant, lower highs, lower lows, it is being sold. One of the things that I'm spending a lot of time with my members trying to discover where the short-term lows of the dollar really start to form, and where we have some asymmetric moment to put on a long trade there. So while the trend is still very dominant on the downside, I think that it's inevitable here that we're going to get some sort of counter trend move, or at least the U.S. dollar re-resuming its 2022 bull trend.
Let's move on to gold here. Eric, what are you thinking of this breakout?
Well, needless to say, the brisk rally of almost $200 an ounce off the early November lows is exciting news for the gold bulls. And as I mentioned last week, I added to my long positions on the brief dip down to $17.20. We briefly tested $18.20 this week, fully $100 over where I added just over a week earlier. So to be sure, this rally feels good so far. But it behooves traders to always do their best to understand why the market is running in their favor, because otherwise we wouldn't know when to take profits. When this rally began, I assumed that the primary proximal catalyst and driving force was the perception that inflation had peaked and that both nominal and real rates would soon move lower. Now, that explanation makes logical sense, but frankly, it's hard to explain a move of this magnitude with that explanation alone. So I've been pondering, what else could be the driver? The next most obvious answer is central bank gold buying. That makes perfect sense, but the catalyst for that was the U.S. seizing Russian FX reserves more than 6 months ago, causing other central banks to begin questioning the security of their own dollar-denominated reserves. But it doesn't explain why the gold market would continue selling off for fully 6 months after the writing on the wall clearly showed reason for central banks to reconsider their U.S. holdings. And then for the gold market to suddenly rocket higher on November 4th, well before the November CPI data was released. Credit Suisse analyst and former Federal Reserve staffer Zoltan Pozsar penned a piece this week positing that Russia might soon begin demanding payment for its oil exports in gold rather than U.S. dollars as a sort of counter-sanction. Someone having inside information that was coming back on November 4th seems a better explanation for the sudden runaway gold price rally than the CPI print alone, which wasn't even out on November 4th. Meanwhile, our good friends at Saxo Bank published their 2023 outrageous predictions, and among them was the scenario of gold moving over $3,000 an ounce next year. So I'll be watching the market closely when we get this month's CPI print next Tuesday, December 13th, and try to gauge the extent to which inflation and policy rate expectations are driving this market, or if something else is in play. I'm generally of the strong opinion that it's probably something else in play, but I'm undecided on exactly what that something is. One way or another, I love the price action so far.
Yeah, Eric. I mean, what's interesting about, is that overall, I get the idea of gold making its big move. In fact, I've always been pretty consistently on my stance that I'm bullish gold over the longer term. The big question for me remains as to after gold finishes this little spurt higher, which I think could easily still see advances towards even 1900. But if the whole stock market was to have a challenging period, and let's just say some sort of tight liquidity conditions, cause the stock markets to wobble and go through another bear decline. The question is that in those kind of liquidity conditions, will gold be able to buck the trend and maintain this upper end, or will we see a lot of deja vu where we've seen we have like even let's say 2020 or any of those other places where you basically had gold just succumb to the selling and go through a sell cycle. And so I have a longer term bull view on gold, but simply asking the question as to whether it could weather those liquidity conditions and hold up. And this is where hedging gold is something that's high up on my priority list as it continues to rally. Moving on though to page 7, I had that chart on crude oil, and what we clearly have is crude oil having broken those lows from September and November on the downside. And the big question is, are we going to see a sell cycle that weakens all the way down to the December 2021 levels where we can, let's say, dip down to $65? Or will this kind of $70 range be able to defend and hold crude oil prices in here? Whether or not there's one quick little dip towards 65 or whether 70 plus holds the lows, I, for the first time, think that there's legit asymmetry in dabbling long crude oil because to me, I don't see the downside risk of crude to being down to like 50 or 60 or something like that on the downside. And even just a return of crude oil back to where it was trading in November near 90 is almost a $20 upside. And so to me, starting to put on some oil trades here, dabbling with where a short-term low may form is certainly something that I'm entertaining here, and something I'm spending some time with the members trying to figure out where the timing on that trade is. Now, with that, on page 8, Nick, we have an option strategy we wanted to share. Like last week, we started talking about different ways to hedge out the downside risk if there was to be another downturn in the market. And we talked a lot about spread trades, but we said that it's a good conversation that we should keep elaborating on. And one of the strategies that we loosely talked about is what's the idea, or what about the idea of using like a butterfly spread as a way to hedge? So I'm going to let you kind of dive into it on page 8 here and explain, how you constructed this butterfly, and then maybe how the payoff profile works, and then we can chat about it.
Sure, sounds good. So looking at this butterfly put spread, the way this works is essentially constructed by buying one 3,700 strike put option for the January next year OPEX, selling 2 of the 3,500 strike puts in the middle, and then buying one 3,300 strike put on the downside right there. So essentially what happens here is you have a debit of approximately $17 right now, which is times 100 shares per contract, obviously. So it's $1,700. And the upside here is up to $20,000 overall. So 20,000 minus 1,700 would be $18,300 upside. Now, again, this would act as a hedge down toward that middle strike of 3,500, which was the October low from last year. So we're looking at those lows as the middle point for the January OPEX. And this is a good hedge because, again, buying the puts on their own is very expensive. So buying those puts will be very, very costly to the average person that wants to hedge their portfolio. This is a more risk-managed approach to hedging your portfolio with less capital. So again, the risk here would be about $1,700 per contract. And the upside here would be maximum 18,311 or so, as it shows right there in the max return box to the left of the screen.
So Nick, so I've put on butterflies before, and the interesting thing, and it's important to note that while it looks like a very sexy payoff profile, it is actually in order to hit that max profit point, you have to be in the sweet spot of being right about the timing and as well the level for this in order to get that max payoff. And often what ends up happening is you're right about the price, but it got to, let's say, the level way before the butterfly is about to expire or something like this. And often what you'll see is that if you're using this as a hedge in the market, let's say, so here we have a hedge that's like 45 days out. So we're a month and a half. You're betting that just in case something starts to downturn here in the post FOMC, and you have out till January for a hedge that has the S&P retesting its year low down, obviously, towards 3,500. Now, if we got there, for instance, in just a month, and there's still 2-3 weeks, you're not going to have the exact same. You're not going to be anywhere near, anyway, the max profitability. But I don't consider that a negative, but it's also just simply about managing expectations and sizing the trade correctly. But what makes a hedge like this even more interesting is if you can find, because it's so cheap to put it on, and it has such a nice payoff profile, if you can find a way to pay for the hedge through creating credit off of your other investments, it allows the hedge to have that kind of almost a lottery ticket effect of helping you when you need it, when the whole market downturns. Like what would you do to approach bringing the cost of this down a little bit further?
So there are many ways you could do that, obviously. One way could be to sell credit call spreads on the SPX directly. If you have a portfolio of long positions already, you could also sell out of the money call options or covered calls against your positions to make up the difference here in the debit amount on the butterfly put spread. That would essentially pay for your insurance using covered call premium on your assets you have in your portfolio. Obviously, that would limit your upside in the short term on those assets. So remember that too. But yeah, Patrick is absolutely correct in terms of understanding that the middle strike 3,500 is the main area where you're going to see the maximum profit. But that being said, if we get there too soon, for example, the payoff won't be maximum profit. You might be there at 3 to 5x return on your initial investment. And my strategy, the way I usually play these positions, is if I have more than one contract, which is usually the case, I tend to sell one contract or half the position when it doubles in value, which then allows me to ride the position for free without any actual risk anymore. So for example, let's say you bought 2 contracts at a debit cost of 3,400 approximately, and then the position doubles in value to 3,400, you sell one contract. That then removes your initial debit cost to 0, and you have upside of 20K. Again, remembering that in order to achieve that, you have to be at 3,500 near the expiration date of the January OPEX for next year. So that's very important to also mention as well. Also important to note too that there are 2 different break-evens on butterflies, as noted in the chart over here. 36.83 is the first break-even, which is the highest strike less the debit cost. And then the second break-even is 33.16 approximately, because obviously if we overshoot the middle strike and go toward the downside, you can also lose if we go below 3,300. So important to note there as well. Butterflies are not typically used by novice investors. They're more nuanced, so it's important to note that as well. But again, just an idea to share to kind of get your creative juices flowing on how to hedge your portfolios with limited premium being spent.
Absolutely, and that's the key is that just buying gamma outright to buy an absolute downside risk tends to be very expensive, and unless you get a really big move in the markets and you're somewhat right about the timing of it, which is what is only the best case scenario for buying just, let's say, an outright put hedge. These are easier ways to carry protection at a much lower cost, and I think that's a very important way of approaching it, is always always having some sort of insurance, but not having it eat away at your returns by overpaying. And so that's why I thought it was a really interesting way that you approach it. Thanks for sharing that, Nick.
My pleasure.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed in the Postgame, and a link to a number of articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases, and also follow Patrick at Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.